Hello, today we're going to talk about creative financing. It's usually what we use to pay for the real estate. So what exactly is creative financing? I think of it as buying real estate without using all cash, maybe we don't have it, or using a bank loan. Most of us don't have $700,000 or however much houses are wherever you happen to live. And also we have to, worry about repairs and holding costs and fees and taxes and all of that kind of stuff. So if we don't have that, we use something called creative financing. Also the thing with banks, it's hard to get a bank loan these days. They want all the tax returns, they want W-2s, all this qualification stuff. And a lot of us that are self-employed real estate investors, work for ourselves, it would be pretty tough getting a loan, so we don't use banks. Number one, my favorite technique of creative financing is called seller financing. This is where the seller finances it for us. We just tell the seller, we agree with the seller, I'll pay you so much a month for so many months at so much an interest rate, and maybe we can add in a balloon if we want. Sometimes a down payment is required, but often it's not. So, seller financing is a great way to go. Another way we go is we take over loans, and this is what's called buying a property subject to the existing loan. It's a great way. We don't assume the loan, but we make payments on the loan on this property, and the seller's name stays on the title of the loan. So why would anyone do that? Well, they would do it if they can't make the payments anymore and they're concerned about their credit, or they want to sell right away. And there's ways to find these sellers, and we'll show you how at our RIA and on more of these videos. A third way, a great way, is lease options. We've done a lot of this over our career. It's also called, by the way, rent to own or lease purchase. This is where we lease a house for a certain period of time, 2 years, 3 years or more if we can get it, and we have the option, but not the obligation, to buy that house within that period of time. And then we can sometimes sell the contract, we can stay in it, and do what's called a sandwich lease option, and we have a whole nother video on lease options, but lease options are a great way to go. You can also just lease the house, and if you can get a long enough lease, you control the house. Or you can just get an option on the house, where you have the right to buy it during that time. And if the house goes way up in price, you can sell the option, you can exercise the option. That's a great way to go as well. Another way to go is with what we call hard money loans or private money loans. They're a little bit different. Private money is usually, I think of as when you borrow from someone that just wants a better interest rate than what they're getting now. Maybe they've got their money in CDs and they'll loan you money that way. Hard money loans are where you get from professionals that they're in it for specific fees usually. And they also get a very high rate of return of interest. With just regular private money loans, you often the interest rate will usually be less than the hard money loans. HELOCs. HELOCs are another way that you can go. HELOC stands for Home Equity Line of Credit, or you can use other lines of credit you might have built up over the years, which can be a great way to go. I would pay them back right away. Another way to go is something called land contracts. They're also called contracts for deed or bond for deed. These are popular in many states. We don't use them that much out here in the West, but sometimes we do, and they can be good. I would rather buy on one than sell on one, because you get into hassles with foreclosures and the type of foreclosure you have to do if you have to take the property back. Another way is what I call horse trading. Not necessarily horse, but it could be. Look, I've got a car or I've got a boat, and I'll trade you my car for your house, or for a down payment on your house, or whatever the seller is willing to accept in return for the house or for a down payment on the house. So basically, another way is just anything you guys can agree on. For instance, okay, I'll buy your house and I'll pay you after I fix it and sell it. That's a great way. That's a great little agreement you could make between yourself and the seller. You get this all in writing, of course. You should get the deed. Always get the deed if you do something like that, because you don't want to fix a house that you don't own and control. Or just, bring in partners. Hey, partner, you put up the money. I'll do all the work. I'll find a place, and we'll split the proceeds. That's great. And a lot of folks get started that way as well. Most successful investors that I know use a combination, either one or a combination of all of these tools. So I recommend you learn them all, and you'll learn most of these at our RIA. So we welcome you to come there. And these are ways that don't usually require any of your own money or any of your own credit. And like I said, you'll learn all of these from our trainers at our RIA here in Los Angeles, also the one in Las Vegas. And so until next time, hopefully you'll subscribe to our videos below, and we'll see you on the next video.